S&P 500 down 1.44% today, closing at 7,365.46.
Ouch.
Yeah, right. And the Nasdaq takes a massive hit, down 2.21% to 25,587.04. Meanwhile, the Dow Jones Industrial Average is basically flat, down a mere 0.09%.
Incredible divergence there.
Totally. The closing bell rang about 15 minutes ago, and the session for Tuesday, June 23rd, 2026 is officially in the books. Today, we're doing a deep dive into the closing print, looking at institutional strategy briefs, internal market breadth, and, global volatility metrics.
Which we definitely need right now. Because if you're looking at that tech sell-off, you're probably asking why the market moved so violently today. Yeah. I mean, was this a genuine breakdown of the AI narrative or just a head fake?
Right. The mission for you listening is to decode this. Is the AI bubble bursting, or is this a distribution mirage?
Well, looking at the internals, I'd argue it's a massive leverage flush. It's a brutal synchronized chop session that heavily disguised a really healthy, broad market rotation.
Exactly. We're going to dig into the volume and breadths today, see what the real money was actually doing into the close, and we'll leave you with a high-conviction day 2 play for tomorrow's open.
So, okay, let's unpack this, because to understand the sea of red on Wall Street today, we actually have to rewind the clock.
Yeah, back to the overnight session.
Right, back to Asia. This wasn't just an American tech slump.
Not at all. The contagion started while most of us were literally asleep. The epicenter was in Seoul. South Korea's KOSPI index plunged 9.99% overnight.
Which is just a historic violent drop.
Yeah, it literally triggered an automatic trading halt. The market had to just pull the plug to stop the bleeding.
And looking at the sources, the catalyst for that halt was foreign funds just aggressively dumping AI chip heavyweights. We're talking about Samsung and SK Hynix. Both of them collapsed over 12%, right, in a single session. And in a hyper-connected global market, a massive hit to Asian semiconductor giants instantly travels across the Pacific. By the time the opening bell rang in New York, that damage was basically priced in.
Hence the 1.4% drop on the S&P and the 2.21% plunge on the Nasdaq.
Exactly. And the information technology sector, tracked by the XLK, took the absolute brunt of it. It plunged 4.13%.
Looking at the specific casualties in the strategy briefs, SanDisk really jumps out, ticker SNDK. It tumbled 13.64% to 1963.60.
Breaking right through that crucial $2,000 psychological support level.
Which is jarring, because literally just yesterday, SanDisk hit a historic all-time high of 2354.39.
A complete key reversal in 24 hours.
NVIDIA was down over 4% too, and Texas Instruments plummeted 8.53%.
Yeah, so if we connect this to the bigger picture, we have to ask why overseas funds suddenly panicked and dumped SK Hynix and Samsung in the first place.
Right. What was the actual trigger?
It was a fundamental stress test of the entire AI narrative, really fueled by two things. First, SK Hynix announced a strategic shift to move some production back to commodity DRAM.
Basically, standard memory chips.
Exactly, rather than dedicating everything to high-margin AI hardware.
Which feels like, I don't know, a massive red flag. The company making the picks and shovels for the AI gold rush is suddenly saying, actually, let's just make regular shovels again.
That's the exact fear. It sparked immediate AI capex skepticism. Investors have watched hyperscalers pour tens of billions into AI infrastructure. But when SK Hynix pivots away, the market wonders if those tech giants are slowing their orders.
Are we overbuilding without the software revenue to justify it?
Right. And then, on top of that, you have a macroeconomic warning from Bank of America today. They warned the Fed might be forced to raise interest rates to fight sticky inflation.
So AI hardware demand might be plateauing, and borrowing costs might go up. It's like, it reminds me of an overbooked flight. Everyone is sitting down, and suddenly someone yells, "Fire!" And every single passenger rushes for the exact same tiny exit at the exact same time.
That's a great way to put it.
But with such high volume dumping, is this a fundamental breakdown of the AI thesis, or just an aggressive, overdue leverage flush?
The institutional internals strongly suggest it's a leverage flush.
Yeah.
But to see that, you have to look away from the tech carnage.
Right, because if you only stare at the Nasdaq today, you'd assume the sky is falling.
Exactly. But the internal market data shows a bizarre contradiction. You mentioned it earlier, the Dow barely flinched.
Down just 0.09%. Here's where it gets really interesting, though. Despite the S&P 500 falling almost 1.5%, market breadth was actually positive.
Yeah, that's the key to the whole session.
which mathematically means more individual stocks within the S&P 500 actually rose today than fell.
Right, because the S&P is cap-weighted. The mega caps, like Nvidia and Apple, dictate the direction. But today, the S&P equal weight index significantly outperformed the cap-weighted index.
So capital wasn't vanishing, it was just rotating. The briefs show money flowing directly into consumer staples. The XLP ETF was up 1.7%.
People were buying Campbell's soup and P&G.
Healthcare and airlines, too. Even Apple acted as a weird defensive bunker, closing virtually flat, down just 0.07%.
And American Airlines, ticker AAL, was the poster child for this rotation. It surged on staggering volume. We're talking 166.1 million shares traded today.
Wow.
Yeah, that's 118% above its average. It closed at $16.14, triggering a technical golden cross breakout, heavily driven by dropping jet fuel prices.
And a golden cross is that signal algorithmic systems use to start aggressively buying.
Exactly. Short-term momentum crossing long-term averages. Strategists call this a distribution mirage. The bull market isn't dying, it's democratizing.
Democratizing.
Yeah. Mega-cap tech is just being used as a massive ATM right now. Funds are withdrawing tech profits to buy beaten-down value and small-cap stocks.
Okay, I hear that, but you call it democratizing. But isn't this rotation just investors retreating to defensive bunkers, like soup and soap? Because they know the broader economy is actually in trouble.
I mean, it's a fair pushback.
They're not buying growth, they're buying survival goods.
But the order flow says it's more about valuation reality. Tech valuations were at nosebleed levels. Soup and soap stocks were at historical discounts.
Okay, so if the big narrative is rotation, we need to ask who was driving the bus into the close today. If retail traders were buying the morning dip, what were the Wall Street institutions doing?
What's fascinating here is this stark divergence. The real money did not buy this morning dip. Institutions actively faded the retail rally.
They sold into it.
Heavily. There was a net negative $1.2 billion sell imbalance in S&P 500 institutional trades today.
A $1.2 billion sell imbalance.
Yeah. And between 1:000 p.m. and 1:15 p.m. Eastern, institutional sell volume just crushed by volume by a massive 12.1-to-1 ratio.
12 to 1. That's at a casino. The house lets the retail players win a few hands in the morning and then aggressively sweeps the table in the afternoon.
That's exactly what happened, and it's reflected in the volatility index. The VIX spiked over 10% today to 19.01.
Breaking past that psychological 20 level intraday.
Right. So the recent volatility dampener we've had, it's gone. Institutions are paying up for downside protection. They're aggressively de-risking ahead of the PCE inflation print.
The Fed's preferred inflation metric?
Exactly.
Yeah.
But amidst all this institutional fear, there was this wild anomaly with SpaceX, ticker SPCX.
Oh man, this was crazy to read. They lost $600 billion in market value over a 3-day slide right after their IPO.
A brutal debut. And they opened down another 4% today. By all logic, a speculative space company should have been crushed on a risk-off day.
But they dramatically reversed and closed UP 1%.
Yep. Following news of a bond offering specifically for internal AI development.
Which perfectly captures the paradox today. The established chip sector bleeds out on AI spending fears, but a space company takes on debt for AI, and the market rewards them with a massive intraday reversal.
The market still wants AI. It's just becoming ruthlessly selective about who it trusts to execute it.
Right. So if the smart money is overwhelmingly selling into every brief rally, how can everyday investors safely navigate this democratized market without getting crushed?
Well, you have to look ahead. You have to understand the mechanical forces dictating tomorrow's open, because the options market has officially entered negative gamma territory.
Right. The quantitative data shows total net S&P gamma exposure at negative $49 billion. The flip line was at 74.45.
And we closed way below that.
I always compare negative gamma to driving a car with no shock absorbers down a road full of potholes. Every bump feels like a crash.
That's a perfect analogy. Options dealers, the ones selling the contracts, have to delta hedge. In normal times, positive gamma means they buy dips, acting as shock absorbers.
But in negative gamma?
In negative gamma, when the market drops, their models mechanically force them to sell shares to stay neutral. Dealer hedging will now amplify market swings.
So the forced selling creates more selling.
Exactly. Which makes the support lines for tomorrow critical. Structural support is at 73.50. but the absolute put wall, the market floor, is at 7,000.
And statistically, the briefs say there's a 62% probability of a morning continuation test tomorrow. Basically, a gap down right at the open.
A morning washout, and the ultimate catalyst for whether that floor holds is Micron.
Ticker MU. They report Q3 earnings tomorrow, and they plummeted over 13% today to 1051.77.
And the crazy part, they fell 13% despite announcing a new AI partnership with Anthropic, and despite Bank of America bumping their price target to $1,500.
So what does this all mean? Good news and target bumps couldn't stop a 13% slide.
This raises an important question about institutional front-running. Institutions are de-risking so hard they won't even wait for the actual numbers. Micron's earnings tomorrow are the ultimate litmus test for the global AI trade.
It either rescues the narrative or triggers a waterfall correction.
Exactly.
But I have to push back on this setup. If dealers are mechanically forced to amplify the downward selling because of negative gamma, aren't we just one mildly disappointing sentence in Micron's earnings call away from shattering that 7,000 floor?
We absolutely are. The systemic risk is immense. But extreme volatility also creates asymmetric day 2 setups.
The sources map out a few specific day 2 plays to watch. First, a potential morning sweep in that 7,300 to 7,350 zone.
Right, for a mean reversion bounce. You wait for the mechanical panic to exhaust itself, then look for the rebound with volume confirmation.
Second setup is Micron itself, testing that $1,000 psychological support. If it flushes under 1,000 but reclaims it on high volume, you might see a rapid pre-earnings short squeeze.
Shorts locking in profits before the actual print.
And finally, Texas Instruments, looking for a gap fill back to its 50-day moving average. But you only take that if the broader tech sell-off shows exhaustion.
Right. Do not try to catch a falling knife if the sector keeps breaking lows. You need volume confirmation.
So, to pull this all together for you, today was not a blind panic. It was a calculated, synchronized leverage flush that started in Asia.
It gave Wall Street the liquidity they needed to rotate out of top-heavy AI stocks.
And move into forgotten value sectors, and that's why you should care. Underneath the red headline numbers, a new market is forming. There is immense opportunity in the S&P 493 if you know where to look. You don't have to just blindly follow the hyperscalers anymore.
It is broadening out. But I want to leave you with a final thought regarding that AI CapEx skepticism we saw with SK Hynix.
Go for it.
We're watching hyperscalers pour hundreds of billions into infrastructure. But if the world's wealthiest companies are finally being scrutinized for this spending without immediate returns, are we entering an era where the market stops rewarding companies just for building AI infrastructure?
Right.
And begins to brutally punish those who haven't figured out how to actually monetize it?
The warning lights are definitely flashing. It's just a matter of who's brave enough to check under the hood tomorrow morning.